If you think your tax bill is high now, then you could be in for a rude awakening. Tax rates are scheduled to go up starting in 2026, which means less money in your pocket and more in the government's. I'm going to show you how much they may go up depending upon different income levels and a few things you can do now to keep Uncle Sam away from your retirement paycheck. The Tax Cuts and Jobs Act, commonly known as TCJA, and the abbreviation I'll use throughout this video, was enacted in 2017 and brought significant changes to the tax code, including lower income tax rates, increased standard deductions, and changes to itemized deductions. However, these provisions are set to expire at the end of 2025. And what this means is starting in 2026, the tax rates will revert to their pre-2017 levels unless new legislation is passed. For instance, the 12% tax bracket will revert to the 15% and the 22% bracket will go back to the 25% bracket. And this increase could have a substantial impact on your take-home pay and retirement savings. So why is the TCJA not expected to be renewed? Well, there are a few reasons. Number one is the political climate. Extending the TCJA would require bipartisan support in Congress, which may be difficult to achieve given the current political divisions. When do our politicians ever get along? And the second is the federal deficit. The TCJA increased the federal deficit, and with rising concerns about the national debt, there may be resistance to extending tax cuts that reduce federal revenue. And lastly are economic conditions. The decision to extend or modify the TCJA will also depend upon the economic conditions at the time. If the economy is struggling, there might be more resistance to extending the tax cuts. Now, before we look at real examples of how different retirement income levels will be impacted, we need to understand what might be changing or going away. The TCJA nearly doubled the standard deduction, and in 2024, the standard deduction is $13,850 for single filers and $27,700 for married couples filing jointly. And without an extension, these amounts will revert to their lower pre-TCJA levels, which were about $6,350 for single filers and $12,700 for married couples filing jointly in the past. This means less tax deduction and potentially more tax to you. The TCJA also reduced tax rates across the board, lowering the top rate from 39.6 down to 37%. And these rates are scheduled to increase once it expires. Now, this chart you're seeing from the Tax Policy Center is from 2018, but it gives you a good idea of what happened. For example, the 22% tax bracket will increase back to 25%, and the 24% bracket will increase back to 28%. The TCJA also capped the state and local tax deduction at $10,000 and eliminated miscellaneous itemized deductions. The state and local income tax deduction cap could be lifted, and that would be a good thing for folks in high income tax states like California or New York, but will it be enough to offset those lower standard deductions? And there are a lot more changes that may take place, but those are some of the big ones. So now let's take a look at 3 different income levels to see how much higher taxes might be in 2026, even if you kept your income the same as 2024. So let's assume John and Karen are currently both under age 65, so they won't receive the additional bump in standard deduction. And I'm also not going to age them when we look at 2026 numbers to try and get the best apples to apples comparison. Let's also assume they create income from both an IRA and a brokerage account to see a mix of taxation. And I'm going to assume that 40% of their brokerage account is gains, meaning that if they create $10,000 from their brokerage account, then $4,000 would be a gain and $6,000 would be a return of capital, aka tax-free. Okay, in our first example, we're going to take a look at a situation where John and Karen need to create $100,000 of just top line gross income. And so what we'll see is on the left-hand column is 2024. And I've gone ahead and filled in some things, just some estimates like taxable interest, qualified dividends, total dividends, IRA distributions. So what I'm saying here is that of the 100K income we have to produce, $60,000 will come from their IRA. And then the rest would come from long-term or from their brokerage account. And again, if I create $60,000 from their IRA and $40,000 comes from their brokerage account. And again, remember earlier I said I'm assuming 40% of their brokerage account is gains. 40,000 times 40% is $16,000 of long-term capital gains. And so that's what you're seeing here. Now, one of the big differences between our current tax law and if TCJA expires, as I've previously discussed, is that standard deductions are projected to go down. And so right now, for someone under age 65, as a married couple, the standard deduction is $29,200. What you'll see is if TCJA expires, it's going to go down by about, at least it's projected to go down by about $10,000. But there is the exemption, the return of personal exemptions expected to be brought back. And that's projected to be about $10,500 for a married couple. Now, we don't know exactly what that personal exemption amount will be, but based upon most estimates, this is in the ballpark, and it's our best guess for what 2026 may look like. And really what you'll notice here is that taxable income would be about the same. Interestingly enough, taxable income would be slightly lower in 26, but because of that higher tax rate, they would expect a higher total tax in 2026. I mean, that's about $200-ish. So really not that bad at the $100,000 level. But now what we're gonna do is we're gonna take a look at $150,000. And so again, now we're not just gonna create $100,000 of income, we're gonna create $150,000 of gross income. And again, what I've basically done here is I've increased taxable interest, qualified dividends, total dividends. I also increased the amount of IRA distributions from the account to $90,000. And then I've also said more needs to come out of the brokerage account, which means more long-term capital gains. You're seeing the same story again with the standard deduction here, as well as exemptions, and a very similar story. In fact, taxable income is expected to go down, but because of the higher tax rate at 15% versus 12% currently, their tax bill again is expected to go up. Now this was $150,000. Now let's take a look at a situation where we need to create, let's just say $300,000. So what might that situation be? I mean, you could have a situation where someone has a pretty large retirement portfolio nest egg, which allows them to take a lot of income. You also could run into this situation, let's just say, where you're wanting to retire early and maybe you need to take out income before Social Security starts. And so you have to really rely upon your investment portfolios to meet your needs. And honestly, in California, you know, people make in a household $300,000, $400,000. It's very realistic here in Southern California. Again, what we'll see is taxable interest, qualified dividends, total dividends, IRA distributions, $180,000. Long-term capital gains, $48,000. Same standard deduction, we get that personal exemption back in. And now we really start to see these higher tax brackets coming into play. Because what we'll see here is that their taxable income is just about the same. In fact, their taxable income is slightly lower, or at least it would be projected to be slightly lower in 2026. Yet their total tax is about, you know, $4,000-ish higher in 2026. They haven't changed anything, but the tax code changed, and that's because their marginal bracket moved from 22% all the way up to 25%. And so you can see how this can really have a dramatic effect, not just in one single year, but project this out over the next 10, even 20 years. We're talking, you know, $40,000 plus even on the low end. Those numbers are helpful because it gives us a ballpark of what we might expect. But what should we do now in anticipation? If you have large expenses planned, such as a rental property renovation, maybe consider delaying them until 2026 if possible. That way you can manage your income and expenses to stay in that lower bracket. Secondly, you may consider harvesting capital gains, and this means selling investments to lock in gains at current lower tax rates. And this strategy can help you manage your tax liability and take advantage of the current lower rate. And lastly, consider converting some or potentially all of your traditional IRA to a Roth IRA. Roth conversions are taxed at your current rate, and future withdrawals are tax-free. And doing this now while tax rates are lower can save you money in the long run. For example, if you convert $50,000 from an IRA to a Roth IRA now, you might pay $11,000 in taxes at the 22% rate, but in 2026, the same conversion could cost you about $12,500 at the 25% rate. But there is too much of a good thing, and you can over-convert to a Roth IRA and actually pay more in taxes. There is a sweet spot in doing this, and if you've ever wondered how to determine the right amount to convert to Roth, then you'll want to watch this video right here. Once again, this is Alex Okagawa, partner and financial advisor here at 1 Degree Advisors. And if you're interested in learning how our team of CFPs can help you gain confidence in your retirement, visit our website at 1degreeadvisors.com.